Hello, it is the 6th of May and the year is 2011, 2011. I think this is the fourth video of the day. A few times I talk about adjusting to the message of the market, and this is one of the few lines or the few lessons from Brian Shannon at alphatrends.net that are really important. And here's a situation where you can adjust to the message of the market. We see on the last few days that we have the moves that bring us from 50 to 33. What this tells us is that the normal trading movements coming up to this Fibonacci line, coming up to this one, therefore having moves like coming up here on a normal breakout, that type of stuff all works in the same on how the candlesticks move together. The only difference is that the numbers are bigger, so instead of having normal moves like this that are like a percent, it's instead that of 11% or something of that nature, which from 33 to 36, that's 10%. This is volatility we haven't seen in quite some time. The trend line has still not been touched yet. However, another downtrend line has been, but it's been resisted as of this time frame, and even getting above that gets you to here, and even getting to there, that's still very a large slope on the grander scheme of things. But on this one, you can see it a little bit more clearly. And we're at this point where we've developed some big support, roughly around 34 and a quarter, pierced below, and we're back in here again. The breakdown should take us down to 31 if it continues lower, and who knows how low it's going to go. Does it go to 25, 28? Are we bottoming now? I'd like to say no one knows, but yeah, there are people that know, but I don't, and I don't think many people watching this do either. Now this Fibonacci level means, say we come up to this mark here, that's 43 or so. It's high like 42.80 or something offhand. That would be a move if we were to make the breakout now from 45 or from 35 to 43 of roughly about 8. So that's over 20%. We haven't had a 20% week since the 1990s, let alone a 20% move. And a chart like this would span so many candles, that's about a day or two. So I find that extremely interesting. Also, if you look at the line, normally when you look at Fibonacci, it looks like an error in the sense, well, this is down too low. And well, so is this one, I think, too. And in a sense it is, yes, but that's because for the first time ever, I'm considering moving the short-term chart from linear to logarithmic. Because normally if you have 7%, 20% moves from top to bottom, 30%, it doesn't make much of a difference. And at 2%, 10%, it really makes no difference. But at 50%, it's starting to make a difference more than anything. If we connect the top and the bottom from this point, we can see that by doing it from here, it does not reach the highs of 49.81. And in fact, the highs actually were up here too. So it's even more so that way. And that means that if we obviously come to these levels, these are areas that you would look to see how the message of the market plays. Usually you'd find resistance here. And then again, if we break lower, these levels are going to continue to go lower, and this chart will be changed to that of a logarithmic time frame. These moves from the percentage basis are pretty extreme. This is what we got here. This is the actual hourly move from the lowest point to the highest point, which is what I'm using to calculate the index. And it's really nothing more than taking this number, adding it to this number, multiplying it by 1,000. That's all it is. It's very simple, but it gets the job done in my opinion. 2%, or 2 and 3/4, almost 2, almost 3, 2 1/3, 3 1/3, 4, 4 2/3, 3. This is wild. These are moves that the stock markets get in a day when it's semi-volatile. In a day. And when it's partially volatile. And this is not normal. And we've had it's in here, there's a lot of the ones under 1. But this was going back to May the 5th, which obviously is now, May the 2nd, moves of 3%. But lately, and this is where it all started in here, the 14% move on Sunday night. But lately, I'm not seeing as many 0% over the last few hours than I have before. Now, a lot of them come on the Asian hours. But if we scroll up to so many random days, this is what we're used to. 0.5, 0.3. Where's the percent? Oh, there's a big one, 1%. Now 1% means nothing. 1% is like so unvolatile. So, all right. Thank you for watching this video, and have yourself a great day. Bye-bye. And a couple quick points before I go. Instead of making a fifth video, I'll just stick this on to the end of this one. I was on Yahoo Finance earlier today, and it's interesting because you think if this was a bubble and everyone was in, and well, a crash would be on all the news channels when everybody's talking about it. But that's not the case. It's interesting because I go to Yahoo Finance and they say, "Will there be another flash crash coming?" Yeah, it just happened actually, but yeah, okay, but no, they didn't talk about a silver flash crash like they did the Dow flash crash last year. No, didn't happen. Even seeing how they said the bubble hit on one of the videos, the one because it crashed so well, and the percentage gains for anyone playing these shorts, any puts, was tremendous, of course. And well, I guess you're supposed to buy back now, or you're supposed to sell, at least sell, which you're really not supposed to do if it's a bubble, because that means it's going below 6 or 7, or at least we're never going to see 50 until past 2015 or 2016. So it's obviously not a reliable article if they're calling it a bubble. But furthermore, they really don't say much at all. I do find that very interesting. I think this is the opposite of that of a bubble, where bubbles bring prices lower exponentially. Well, that would be exponential growth. When there's dealers on the internet whom state, you know what, it's going to be 2 weeks for these eagles, and these particular maples are 4 weeks. We're completely sold out of grizzlies, but we have a little bit of this and this. But every day something new is going on back order because, well, we can't get any more of these for a few weeks ourselves. That's really showing bubble signs within the supply and demand issues. On a sarcastic level, it doesn't. Then again, we're now moving into Sunday. Just because the fundamentals state that, oh, it's going to go up higher, doesn't mean it's doing it now. It can very easily be the bottom now, and we could gap up and be at 47 at 8 p.m. on Monday. Or Sunday, I mean, or even either or. It's possible. It's not a surprise. That's a better way to say it. It's not a surprise. Everything goes down Sunday. I would be expecting it to push down to 31.30. I'm not liking how this is playing out, but at the same point, I know this has to end at some point. And if you start calling bottoms here and you do it every so often, you're most likely going to get it right. But that's obviously different people's strategies. If you're playing on a paper market, you can easily get hurt. It's getting to the point where by holding any paper assets, this is probably one of the major things that leads up to it. All the big things now happen on Monday morning. Bear Stearns was a Monday morning event. We had the Monday morning Lehman Brothers event. I'm not sure about AIG or GM, but it wouldn't surprise me if they were. And last week, we seen the weekend event also, and the market on Sunday night always adjusts accordingly, starting with major volatility. Therefore, when we are in the market Sunday, having continuation of these major moves, whether it be down or up, is by far not that much of a surprise. And I will be completely surprised if the volatility really lightens up in the next few trading days.